Last episode, we covered the massive physical bottlenecks of AI infrastructure: electricity, grid capacity, and cooling. Today, we are going deeper into the undeniable giant at the center of this universe, NVIDIA. Edward, what is NVIDIA, and why does it remain the foundational pillar of the AI revolution?
NVIDIA is the global leader in high-performance graphics processing units, or GPUs. Originally built for gaming, their parallel processing architecture turned out to be the perfect engine for artificial intelligence, deep learning, and sovereign AI clusters. Today, virtually every major tech company and research lab relies on NVIDIA hardware and their CUDA software ecosystem to train and run massive AI models. The key to NVIDIA's dominance isn't just the raw silicon. It's their ability to optimize the entire full-stack platform, delivering the fastest training and inference times in the industry.
Let's talk numbers. How do NVIDIA's financials look right now?
The growth trajectory is unlike anything we have ever seen in mega-cap tech. Trading right around $210 per share, up roughly 46% over the past year, NVIDIA currently trades at a trailing PE of 31 and a forward PE of 23.6. That forward multiple is well below its historical 5-year average PE of 53. In Q1 FY 2027, NVIDIA delivered $81.6 billion in revenue, up 85% year over year. The data center segment alone hit a record $75.2 billion, surging 92% as demand for their Blackwell platform exploded. Gross margins came in at a remarkable 75%, while return on equity sits near 109% and return on invested capital at 99%. With a PEG ratio of 0.45, the fundamentals suggest the market may still be underestimating its long-term cash generation.
That's incredible momentum. And I hear NVIDIA is expanding beyond chips into clean energy.
Exactly. And this is the angle most investors have not connected yet. NVIDIA recently partnered with Fervo Energy and the Pacific Northwest National Laboratory to build an AI-powered digital twin of geothermal reservoirs, the EGS Twin platform, using NVIDIA Omniverse. Fervo's Cape Station project in Utah is bringing 100 megawatts of clean 24/7 geothermal power to the grid this year, scaling to 500 megawatts by 2028. NVIDIA is positioning itself not just as a provider of AI compute, but as an active orchestrator of the clean power needed to run those data centers.
So what is the bull case here?
Two things: unrivaled operational leverage and shareholder return. NVIDIA isn't just selling chips, they are building entire AI factories. As agentic AI and multi-agent workflows explode, inference compute requirements are growing exponentially. Management also authorized an $80 billion share repurchase plan and raised the quarterly dividend. With a market cap near $5.1 trillion, NVIDIA has an unmatched balance sheet to fund R&D and stay years ahead of competition.
And the bear case, what could go wrong?
The biggest risks are macro and structural. First, hyperscaler concentration. Over 50% of data center revenue comes from a handful of cloud giants. If their AI capital expenditure slows even slightly, NVIDIA feels it immediately. Second, competition. AMD is making strides, while major cloud players are designing their own custom chips to reduce NVIDIA dependence. And third, geopolitics. With chip fabrication concentrated at TSMC in Taiwan, any supply chain shock poses immediate risk.
What are retail investors missing that institutions already know?
Retail investors get caught up in daily price swings or simple chip comparisons. Institutional investors look at the CUDA software moat and the turnkey rack-scale platform. Once an enterprise builds its software stack on CUDA, the switching costs are astronomical. Institutions also recognize how NVIDIA is embedding itself into physical AI, from geothermal digital twins to autonomous robotics, ensuring they capture value far beyond cloud data centers.
What about macro factors? Rates, trade policy, power grid constraints?
Because NVIDIA is debt-light with tens of billions in free cash flow, higher interest rates don't directly hurt its balance sheet. However, high rates raise the cost of capital for customers spending billions to construct energy-intensive data centers. Global trade restrictions on high-performance AI chips also remain a constant wildcard for international market share.
Powerful story. Now let's move to the second name today. One that doesn't get nearly enough attention from retail investors. Arista Networks. Edward, as someone looking at the AI compute boom, why should investors care about networking?
Think of it this way, James. GPUs are the engines of AI, but networking is the central nervous system. If thousands of GPUs cannot talk to each other in microsecond synchronization without packet loss, the entire multi-billion-dollar AI cluster sits idle. Arista is the undisputed leader in high-performance data center networking. Their cloud-native operating system, EOS, and their high-speed Ethernet switches carry the massive data flows for hyperscalers like Microsoft and Meta. Without Arista, the cloud and AI infrastructure simply grinds to a halt.
That makes the strategic role very clear. Let's dive into the numbers. Can you walk us through Arista's recent financial performance?
Arista is delivering incredible top and bottom line execution. In Q1 2026, revenue hit $2.709 billion, up 35.1% year-over-year, beating earnings estimates with a non-GAAP EPS of 87 cents. Management raised full-year 2026 revenue guidance to $11.5 billion, representing 28% annual growth, and they are targeting $3.5 billion specifically in AI networking revenue this year. They maintain an exceptionally high non-GAAP operating margin of 47.8%, generated $5.28 billion in free cash flow, and hold over $12 billion in cash with zero debt.
Zero debt and a 47% operating margin is impressive. What makes Arista special right now beyond the numbers?
Their technological pivot to the XPO liquid-cooled optics platform. In massive AI data centers, XPO reduces networking racks by up to 75% and saves 44% of floor space. In a world where data center floor space and power are scarce commodities, that efficiency is a massive selling point, and their Net Promoter Score of 89, meaning 94% of enterprise customers are overwhelmingly positive, shows the depth of customer loyalty.
What is the core bull case for Arista?
Ethernet displacing proprietary networks. Historically, NVIDIA's InfiniBand was the default for AI clusters, but as clusters scale to hundreds of thousands of GPUs, hyperscalers are demanding open, flexible, high-speed, Ultra Ethernet, which is Arista's core domain. That secular shift, combined with their EOS software moat, once a cloud provider runs their entire network on EOS, switching costs to a competitor are prohibitively high, makes Arista one of the most defensible businesses in AI infrastructure.
What are the key risks?
Two stand out. Customer concentration. A massive chunk of revenue comes from just Microsoft and Meta. If either delays their AI capital expenditure cycle, Arista feels the impact immediately. And supply chain lead times. Managing component inventory amidst global bottlenecks remains a delicate balance, especially as demand for ultra-high-speed optics spikes.
Any final thought on both names today?
NVIDIA and Arista together represent the full picture of AI infrastructure investing, the compute engine and the nervous system connecting it all. Both are best in class in their domains, both are supply constrained, and both are still underappreciated by most retail investors relative to their long-term positioning.
No AI. Invest in AI. See you next episode.
And amid all this, do not forget the most important investment of all, enjoying the beauty of life.